All right, what's going on, everybody? Welcome to another episode of Catalyst Conversations. Today we've got a Drew Townsend, who is a mortgage guru. That's what I'm going to call him. I've certainly done some business with him, and he is here to give us some insights into his growth as a business person and into the mortgage industry. But first, Drew, start us off with a dad joke. I know that's kind of your...
Yeah, it is. I got a question for you.
Send it.
What do you call a gardener who went crazy?
Gardner, crazy. Van Gogh.
No, he was hearing voices in his shed.
Okay, that's solid. That's solid. We'll give you that one. Okay, all right. So tell us about. We can talk about how you got into dad jokes later, but tell us about how you got. Give us your life story in a nutshell, and specifically how you got into the mortgage industry.
Yeah, so I graduated in 2009. There was not a whole lot of jobs. I had a degree in accounting. Right after the financial crash, the dust was kind of settling. Kept looking for jobs in corporate accounting. In college, I had an internship doing, federal tax returns. And so, there just wasn't a whole lot out there. Would always come in, like it would be me and one or two other people vying for a job out of like 100 people. And so I said, you know what, like I was getting married in a couple of months after graduating. Right. And I said, you know what, I got to just find a job. So I took a job at a credit union. Okay. And obviously they knew I had a college degree. So they said, we'll work you up quick, but we got to start you off as a teller. So started off as a teller, worked my way up pretty quick, opened up a handful of offices for the credit union, and then was approached by a mortgage loan officer. I was doing mortgages at the credit union. Was approached by a mortgage loan officer that said, hey, why don't you come out, right, with me as a junior loan officer, and I'll teach you the mortgage business, right? And so I like the idea of being able to provide a better service than just the typical 9 to 5 that I was able to provide when I was at the credit union. So yeah, so that's how I kind of got into the mortgage business. Okay. And it's cool because I'm still using that accounting degree, but my personality isn't necessarily a back office accountant.
Now, would you, being in the mortgage industry, would you consider yourself? Well, first of all, tell us. You have. I know you've been with a couple of shops, but tell me how you got into Fairway and your role there. Do you sit on top of the local office, the Fairway office, or where are you in the structure?
So I work with Fairway Independent Mortgage Corporation, and so I had worked with a couple of companies following that loan officer around that got me into the business as his junior. And we had started working at a company called Sage Bank, which isn't around anymore, but it was a bank that owned a mortgage company, or a mortgage company that owned a bank rather.
Right.
But I was there for about 5 years, and kind of saw some writing on the wall as to they just weren't operating the way they probably should have been.
Sure.
And so I started looking. I looked at 18 companies actually before going to Fairway. Okay. I don't like moving around. And I found them, and the fact that they're employee owned. We're very unique in the mortgage space. Just for a company of our size, we're typically one of the largest lenders in the country every year. And we're usually the largest non-bank or online lender. Wow. So we call that the street. And so I'm actually the sales manager for the local office at Long Meadow. So I have about 7 loan officers underneath me, and that I just kind of help grow their business, right? Okay. So not necessarily underneath me, but I help them in terms of just growing their business, what their goals are, helping coach them up on that.
Okay, now as in that role, and obviously mortgage lending is I would say a traditional kind of industry, but where is the crossover when you think of the word like entrepreneurship, or would you consider yourself an entrepreneur, or if not, where do you feel entrepreneurial in your current venture? I mean, obviously for mortgages and for real estate salespeople, it's a lot of just working on commission. So it's certainly, you have to have sales, and there's some crossover there. But where else would you use the term entrepreneurship or entrepreneurial in your
Yeah, I
line of
mean,
work?
you're definitely. I would definitely consider myself an entrepreneur, right? Because
Right.
it's what it's what we call a book of business, right? And so that's like my clientele. That's my referral partners, and so it's your own business that you're operating. I'm just doing it under a shell at Fairway. So it's a yeah, it's definitely entrepreneurial in the fact that you eat what you kill, right?
Right.
And so, or you sing for your supper, so to speak, is kind of an old sales term. But yeah, it's definitely entrepreneurial. In terms of evaluating your business model as well for the changing and adapting environments, right? So, over the last 2 years, we've had to drastically change and adapt our business model as well, especially coming off of like 2020, 2021. So in that regard, it's you basically are like owning your own business.
Okay, that's a good insight, and we're going to talk more about your the specifics of the mortgage industry a little bit later. But taking just a slight detour, let me ask you this, and you may have heard this question from the other interviews, but let's just say your memory was going to be erased in 5 minutes from now, but this new reincarnated you was going to also be in the mortgage industry. What's one piece of advice that you would leave for the new you as a loan officer or somebody in the mortgage industry? And then what's one piece of general life advice that you would leave to yourself?
So I would say the piece of advice for the business
Right. We'll start
would
there.
be always pick up the phone, right? So in the mortgage industry, there's a transaction going on. There's usually a high level of stress and anxiety,
Right.
because you're dealing with people's lives, right? And their shelter, and so
And probably their biggest investment.
absolutely, yeah. That is new to them, no matter how many times they bought a home.
Right.
Each experience is always new, right? And it's a very stressful environment. And I find that a high level of communication doesn't eliminate that, but it drastically reduces the amount of stress and anxiety a home buyer going through the purchasing process experiences. So to me, always pick up the phone, especially, not every deal is going to go smooth. So it's when the deal's not going smooth, a lot of loan officers tend to just go into like a turtle shell.
Right.
Right. And they're MIA, and that's the worst thing you can do, because, everybody's worst, fears, like what they're thinking in their head is a lot worse than what's actually going on. And people just want to know. And if you don't have an answer for them, that's the problem. A lot of loan officers don't pick up the phone because they don't have an answer. Right? Well, pick up the phone. Just tell them you don't have an answer. It only compounds the problem and making it worse by not picking up the phone. So that's the first thing. Always pick up the phone. Always communicate. That I think was actually one of the first pieces of advice I got from a real estate agent when I got into the mortgage business. It was one of the first agents I grabbed a cup of coffee with. So that'd be the first piece of business advice.
Okay.
The next piece of business advice I would give actually came from my father.
Okay.
And it is, if you're going to be a ditch digger, be the best darn ditch digger you can be. Right? So basically what that means is, no matter what you're doing, if something's worth doing, do it to the best of your ability.
Right.
Right? So if you're going to do a thing, you don't do 70% of it. You don't give 70% effort. You do it to the max. And so that was always a thing. Let's say in college, maybe my first semester grades weren't, indicative of my potential.
Right.
And my dad, asked the question, and it was, did you work as hard as you could have? It wasn't berating. It was just, it was allowing me to be self-accountable.
Right.
Did I give the full measure of effort? So that would be probably the piece of advice I would give to those two pieces of advice I would give to myself.
Yeah, that's a question that probably everybody should have top of mind, because you can always it's a quick way to be honest with yourself, and you can probably always even if you're like, yes, I'm doing absolutely everything that I can and that I should be, it's still good to do that that bit of accounting.
Sure.
Or that audit. Okay, so let's say that I'm Johnny Youngster. I just coming out of high school, trying to figure out what to do with my life. what would you say to recruit me to your industry? As, let's say, as a loan officer, or maybe somewhere else in the mortgage industry?
Yeah. Well, the first thing I would say is go to a bank or credit union.
Okay.
And I have that conversation probably with 99 out of 100 people. And the reason for that is because our business is 100% commission. And so when you're coming in, you're making mistakes on your own dime. And so if you go to a bank or a credit union, you're doing mortgages, you're going to make those mistakes on their dime.
Right.
And so it allows you to learn the business, build a book of business, establish yourself with some knowledge, industry knowledge. Because there's a lot of people that come into this business and they have no idea how to do it. And when I say I'm a good loan officer today because I made a lot of mistakes.
Right.
And you got to learn from those mistakes. And so I think that's the big thing. So, especially over the last 2 years, there's not a lot of people getting into the industry. In fact, I think at the beginning of last year, out of 350,000 loan officers, 50,000 of them didn't renew their license.
Wow.
And I think it's going to be even more compounded this year, which is good because that's a huge opportunity for market share growth for me.
Yeah, absolutely. Now, when you say that when you're working with a bank or a credit union, would you recommend that somebody starts just as a teller like you did, or move directly into mortgages?
I think it depends on their level of experience.
Okay.
And really, if they're coming out of high school, generally they're going to start at a position like a teller, right? And that position is going to allow them to kind of work their way up, and really kind of figure out where they want to be, right? Because there's an option. I just as easily could have gone down the road of like a commercial lender. Right. Which is a totally different animal in and of itself. So, I think it allows them to kind of figure out where they want to go. Because I think the business is not necessarily for everybody,
right.
And once again, I just as easily could be a financial planner, right? It's kind of like a passion of mine. But my path just kind of didn't lead that way, and I'm kind of like the opposite side of the same coin as a financial planner.
Right.
In fact, I actually bring a lot of them into the conversation with my clients too.
Okay, great. Yeah. Now, obviously, in your industry, we've got very large numbers that we're dealing with, and so everybody wants to make sure that the person who's stewarding their mortgage or stewarding them through the process is top notch. So give us some. You've kind of already mentioned some industry things, but what does good look like? What does great look like? What does not good look like? If I were to be looking for a mortgage and I called Mr. or Mrs. Mortgage down the street,
yep.
Give me the breakdown of what I would know about that person based on how that conversation went.
Yeah. Excuse me. So not good right off the bat is kind of goes back to my piece of business advice is they're not going to be returning a phone call.
Okay.
So one of the goals that I have in my personal business is that every client feels like they're my only client.
Right.
So if they're not picking up the phone and communicating, especially while they're trying to earn your business, right at the start, that's a bad sign. The other thing is if they rush you off the phone, they don't take the time to talk to each person, right? I don't end a conversation without going, hey, are there any other questions or concerns, that you might have? We talked about a lot of information while you're digesting it, right? Thinking it over, feel free to shoot me a text, right? Afterwards, I'm more than happy to kind of, give you a quick answer. So I think that's where it kind of starts to be good, into the realm of good, where somebody's going to be taking the time to communicate with you, not rush you off the phone, and just communicate in general. I think great is where you come at it from a level of an educator, right? So at the end of the day, my job is just to educate, right? I will give a client my 2 cents on how they should do it, but my job is to educate them on the different financing strategies, programs, options that they have. And if I've done that correctly, they'll feel comfortable being able to make a decision, right? Now, most people go, well, what would you do, right?
Right.
And I'll tell them that, but it's always easier for me to take away education from somebody that doesn't want it, and they go, hey, honestly, whatever you want to do, just do it, than to give it to somebody who wants it and isn't getting it. So I think that's the separation between good and great, is really taking on the role of the educator in this process, because that industry is, the mortgage industry is always always evaluating, or evolving rather, in terms of guideline changes, and people don't do it frequently enough to really understand it. So each time it's new. My second, third time home buyers, it's always new to them.
Right. Well, and I've had personally had conversations with you where you take a look at the kind of the broader scope of what else fits into your financial picture, and does it make sense to go to put down this amount versus a smaller amount, because what else is on your plate financially?
Yeah, so I call that. So I'm classified as like a mortgage planner, in that I don't look at the mortgage as a singular event. Right?
Okay.
So I look at the overall financial picture. And so, for instance, a lot of people, the average loan to value right now is somewhere between 40 to 42%. So people have a ton of equity in their properties.
Right.
So on my resize buyers, whether they're upsizing, downsizing, whatever that might be, the conversation I kind of have with them is, okay, what were you thinking about using from the proceeds of your sale, right? And most people go, oh, I want to use all of it, right? And so I said, okay, well, I'm going to kind of go through my order of attack with you, right? Once again, it's just educating. Okay, what they feel comfortable with, is the decision they need to make. So the order of attack that I say is, okay, let's come up with, option one is, or plan A is coming up with a down payment that makes their monthly payment feel comfortable, gets them into a comfortable range.
Okay.
The second option is attacking debt, right? I had a client going from a $300,000 house to a $600,000 house, and rather than putting 20% down, I had them put 10% down, and they were actually paying $1,200 less a month.
Wow.
Doubling their house size, right? Purely just by attacking debt, using some of the proceeds to pay down debt.
Sure.
So that's the second plan of attack. The third plan of attack is establishing 6 to 9 months of emergency reserves, right? Many people overlook that. They don't factor that in. And I always bring up, hey, if something happens to your ability to earn income, does having, it's $7 per thousand, right? Mm-hmm. So for every 10 grand they put down, they're going to save $70.
Okay.
So the conversation I have with them is, hey, if you're talking about putting an extra 20 grand down, does having a $140 lower monthly payment help you, right? If something happens to your ability to earn income, or does having 20 grand in reserves help, right? Oh. And sometimes I have an accountability test conversation with them. Do you feel like you can maintain, savings, right? If somebody has a lot of equity and they don't have a lot of savings, then that leads right into my fourth option, which is, hey, let's have a conversation with a financial planner. Right? Whether it's long-term investment, whether it's just accountability, right? Same reason why people, with a gym membership, maybe hire a personal trainer. It's all about accountability, right? And so, so we have the conversation about a financial planner. Then we talk about, okay, does it make sense to put more money down, right? And in fact, I encourage them, if you don't have a financial planner, right, or do you have a financial planner, let's bring them into the conversation, right? You're making a big change, where it's very rare you get these opportunities in life where you're selling a home, getting a big influx of cash, and buying another asset. Let's make sure we're making the right decision, right? Mm-hmm. So part of what I do, once again, from an educator standpoint, is talk about forecasted appreciation rates, right? So I have a software program I put all the loan options into, and it's a slide bar, and we kind of go out and we go, okay, well, what does it look like in 2 years, 5 years, 10 years, right? And it'll factor in what they're putting down on the property, the appreciation rate of the property, like for the county, and what they're going to be paying in principal over that time frame. So a lot of the conversations I'm having with clients that are talking about, let's say, putting 20% down is, hey, let's do 10% down, and if we're looking at an appreciation rate of 4% per year, maybe with some upgrades in 2 to 3 years, if rates pull back to a level to make sense to refi, well, now you're using the market appreciation to eliminate or significantly reduce your PMI payment, your mortgage insurance payment, without bringing any additional cash to the table.
Yeah.
Let's say the market stays flat. Nothing happens with home values. I don't think that's the case, but let's say that the market stays flat. Well, now you have the cash to bring to the table at that point in time, right? So cash, to me, gives them the freedom and the flexibility to make a decision. Once they put the money down on the loan, that's it. They're done. Right.
That's
and so it's just educating them on that option, which I think is important because, once again, people don't take the time to have that conversation with them. I would say probably 80% of the people that come to me with the intention to put 20% down, after looking at the numbers, decide to put less down.
Right.
Right. Including a client currently under contract that was thinking it was hundreds of dollars, and for them to go from 20% down to 10% down, PMI was $30 a month on a $445,000 purchase. Right. So it was, that's nothing, right?
Yeah.
Why bring an extra 45 grand, to the closing table for $30 a month? Doesn't make sense.
Yeah, and this word options is so critical. I mean, I think sometimes we get in this rut where we think that here's the traditional path. This is what all the textbooks say, and whatever. But especially before a huge financial decision.
Yeah.
To like Steve Covey says, okay, well, think win-win. Which is to say that just like he gives this example in the 7 Habits of Highly Effective People, where one guy wants the window open and the other guy wants the window closed, and so that the compromise is to leave the window half open. But when you think about it, he's like, oh, okay, well, can we move the desk? Can we make something about the inside of the room different so that both guys win without even factoring in the window?
Yeah.
So it's really important to zoom out like you do and look at the mortgage and figure out, okay, well, while I'm moving money around, where else can we leverage what we've got at our disposal?
Yeah. People look at the individual tree; they don't look at the whole forest.
Right.
So I was like, hey, let's back it out. Let's look at the whole forest.
Yeah, that's great. Now, I'm sure you've seen this. Maybe I want to say probably on more transactions than you'd like. But when something goes wrong, because like we talked about mortgages, we're talking about large ticket items, we're talking about a lot of, especially in a very high seller's market, where there's a lot of emotion attached. So when something goes wrong, give us maybe an anecdote about how you resolve that, or at the very least some learnings from something that maybe was beyond recovery.
So I would say, once again, coming back to I'm a good loan officer today because I've made mistakes. So now it's kind of like the old adage, a pound of prevention is worth an ounce of prevention is worth a pound of cure.
Yeah.
And so it's what I kind of readapted that to where it's 10 times more effort and energy to fix a problem than to prevent a problem. Right? So whether that's something as simple as me just mentioning in one of our initial conversations when I'm asking about assets, is any portion of that cash under the mattress, right? Serta money, Bank of Serta, or is it any large deposits from non-payroll gone in the last let's say 60 days, 2 months, and so I'm trying to identify issues with cash deposits up front, before we even start that process, because once again, that's a lot more. You can't source cash, so we can't. It's usually not. It's usually hard to verify those funds to be able to use them, right? So, in the past, I mean, I've had clients where, we're going back probably like maybe 8-10 years now, where I had some clients, and it was the week before Thanksgiving. I'll never forget it, and I had to tell them that they didn't qualify for the home.
Oh no!
And it wasn't anything that we missed, right? However, it was. Had I maybe had conversations with them, they just couldn't keep money in the bank. And had I maybe had more of an accountability role with them, staying on top of them, maybe they would have, ended up purchasing a home. Now, they ended up sticking with me and becoming a homeowner, but it just wasn't that particular property that, the deal fell through. But,
sure.
So that was tough. Having those tough conversations is not fun.
Delivering news that bad, I can imagine your stomach's turning.
Oh yeah. And I kind of call it embrace the suck. Just get in, get it done, right? Most people don't want you to beat around the bush with them.
Right.
They want the answer up front right away, right? And I still have to have those difficult conversations with clients, but we do it at the time of pre-approval, right? Oddly enough, I actually had one where I was texting the 2 clients and the real estate agent. We were all in a group text, and I told them they didn't qualify. They needed to wait another 6 months. They had some job movement, and so they just had some variability in the income and needed to establish some additional history at that job. And she started telling me dad jokes as I'm telling her that she didn't qualify. Right. So it softened the blow a little bit, I guess.
Sure.
But yeah, that's never difficult. But I find if you rip off the Band-Aid and you tell people up front, right, with it, I think you always need to set expectations properly, right? And so that's what we do up front. And everybody I tell, listen, no deal goes completely smooth. There's always one speed bump, right, or hurdle, and we just got to figure out how to get around it, over it, underneath it, through it.
Right.
We'll figure it out together. And so, I just find that setting the expectation about the transaction up front correctly, whether it's timeline, whether it's, whatever it might be, right? And it's kind of, it's understanding those issues and being able to kind of go, okay, hey, this is going to spiral into that, right? And it's just from having done it for so long in the industry,
right.
I can kind of see the future with it. But once again, that all comes from, making those mistakes in the past. Whether it's not knowing guidelines, not staying on top of things, not asking those additional questions. But yeah, I would say one last thing just to add to that.
Sure.
I tell my clients that they don't hear a no from me, they hear a not right now, and that comes with an action plan, or what I call a path to an approval.
Right.
Right? So it's, you keep the blinders on, right? And it's one foot in front of the other, and you're not looking at the mountain, you're looking at the next step. Right? So whether it's credit repair, whether it's, them going on the ramen noodle diet to pay off some debt, right? If it's not a necessity, hold off on buying it because maybe they need some additional funds. Whatever that is, we do it with enthusiasm because we're genuinely excited for our clients, right?
Yeah.
And so, it should be a fun process, right? And so I think they feel that even in just the conversation, the energy in the voice that like, hey, we're excited for you to become a homeowner. Anything worth doing isn't always easy, and homeownership is worth doing, right? And we can get into that later, just all the benefits of homeownership historically, right?
Right.
But I think it's just being passionate about it and going like, you have a partner in this with you, right? Like we're gonna I can only meet you halfway. I can't do the work for you, right? But I'll meet you halfway, right? And I think that's the other thing. That's part of the educator that I had mentioned before, right? An educator's willing to meet the student halfway, but they can't do the work for them.
Right. Yeah. That's the nature of being in a supporting role. Is that the main actor still has to act, but it's really good to consider who you have just in whatever you're doing. It's really good to consider who you have as a resource, because as a realtor, it's good to be educated about the mortgage industry, but if I really need to have somebody give me the gory details on what's the small difference between this product and that product, or somebody's buying farmland or whatever, it's really good to tap into a resource that's got that specializes in a particular area.
Yeah.
Yeah.
I kind of tell clients sometimes, it's like those charts where it's like they ask the question, no, you go this way, yes, you go this way.
Yeah, those decision trees.
Decision tree, yeah. And, I kind of tell clients, it's like, everybody's unique and specific, and there's no generic answers in the mortgage industry. So I tell clients it's a, the answer could be yes if it's a, Friday before 4 o'clock and it's warmer than 20 degrees, right? And it's not raining,
Right.
It's like every answer is very specific. And so, it's just seeing where they stand, right? What their goals are, and then basically giving them the options of the financing strategies that most efficiently and effectively accomplish those goals.
Right. Okay, that's great. Now, because everybody, I think, at least once in their life is going to go through the home, or at least considers the home buying process, just give us a real quick and dirty take on the mortgage industry. I mean, obviously, so we're in December of 2023. What does the housing market look like from the perspective of a mortgage lender?
Sure. So limited inventory.
Okay.
Right? Especially in the Northeast. We have very limited inventory because they're not making any more land. Right?
Is there a place in the country where the inventory is not so limited? Again, based on what you know.
Midwest.
Midwest.
A lot of things are grid. Right? So they're putting new homes
about that.
On the grid. Right? And so they can fit a lot more homes, in those, like, let's say subdivisions, right, as they build them out. Builders are more prevalent. The problem that we have in the Northeast is, and really on both sides of the coasts, right? Is the land. Any builders, there's very few and far between where they're doing like over 20, over 30 homes in a subdivision. It's like onesie, twosie, or like, maybe they get 5, right? And so it's purely an issue with land. However, a lot of this stems from the financial crash going back to like 2008, 2009, right? And so builders kind of got out of it, right? Out of the business, right? Or they slowed down significantly.
Right.
And we're just seeing that population growth, right, with the millennials. Millennials, there's more millennials turning 30 every day than ever before. That's the average age of household formation. The biggest buyer segment right now, age-wise, demographically, is 27 to 35-year-olds.
Okay.
Right? And so, in Hamden County alone, they're projected to take up, I think, 63% of inventory.
Right.
Right? So, builders just weren't ready to keep on pace for transactions or for buyers. So, what's interesting is if you actually compare today to 2008 on a national level, there's 3 million fewer homes available for sale on a monthly basis.
Wow.
And there's about 14 to 16 million more households in the United States.
Wow. Yeah.
Right. So
huge
that's
crunch.
kind of the issue that we're dealing with. Now from a mortgage perspective, that's kind of a real estate, right? But the real estate market also kind of drives the mortgage market.
Sure.
So from a mortgage market, oddly enough, 30%, a third of all mortgage applications, which are essentially at 40-year lows, the level of mortgage applications right now, a third of them are still refinance transactions, even with rates hitting 20 to 23-year highs.
Yeah. Now, why is that?
A handful of items. One is a lot of divorces.
Okay.
Or separations or buyouts. And so you have two people that, were either married or not married. They bought the home together and now they're no longer together. And one person's buying out the other person through a refi, right?
Okay.
The other thing is debt consolidation refis, I think is driving that too. You have consumer credit card debt hitting $1 trillion for the first time ever. At a time when interest rates are, I think the average credit card rate is probably 24%, somewhere around there. So you have a lot of people that, even though they're at, let's say, a 4% on their current mortgage, we look at their blended rate. So I go, okay, how much credit card do you have in debt? How much credit card debt do you have?
Yeah.
Let's say it's $50,000, right? That's the average household amount of credit card debt right now.
It's
wild, right?
That number is insanely high.
It's very high. So check out car loans. Car loans, the average car loan payment right now is $800 or more.
Right.
Right? And that's with 7-year. I think something like 23% of all car loan payments are over $1,000.
Wow.
Right? And that's with 7-year car loans now being the most popular term, right? So there's just a lot of debt. I think, coming off of, COVID, stimulus, things like that, just consumers haven't stopped spending while inflation was also going up. And really they were driving inflation by doing that too. So I think it's made debt consolidation the biggest, most attractive thing because they have the equity in the property. That's the biggest difference that we have right now, in my opinion, other than good lending terms. Right, because we're making loans on good lending terms now compared to pre-2008, where if you could fog a mirror you could get a loan, right?
Right.
But it's looking at the blended rate and going, okay, well if you're at credit card debt of this, car loan of let's say 8%, right? Maybe you have a home equity line which is 10 to 11%. Let's factor in all those amounts, and even though you have $200,000 left on your loan at 4%. Your blended rate is really 7, right? So let's have a conversation about refinancing. Then we look at the monthly cash flow. We look at all the factors, and actually my system does something pretty cool too. Is where I go, okay, well if we do this transaction and you're saving X amount of money per month, let's say you have 15, let's say you have 25 years left on your loan, right? You're going back out to a 30, but what if you were to continue making those same monthly payments every single month? how much sooner would you pay your loan off in, right? That can go to savings, into the account. It can go to the bottom line, to make sure you're not going into debt, stop the bleeding. But if we apply it to the loan, what does it look like, right? I had one client going from like 4.25 to 7.25 like a year ago, eliminating all her debt. And when we did that math, even though she had, I think, 25 years left on the loan, going back out to a 30, if she applied this monthly savings to the loan, she'd pay her loan off in 7 years.
Wow.
That's pretty wild.
Yeah.
Right?
Yeah.
So that's cool because we look at it, we kind of flip it, and we don't just focus on the monthly savings. Excuse me. But we flip it, and we go, does applying that money on the loan still make it the best move for you? Right?
Right.
Maybe they do it, maybe they don't. It's just looking at it from the opposite angle.
Okay. Yeah. Now, looking at stepping away from the specifics in the industry and looking more at your kind of the way that you do business, what are some of your isms? And by that I mean, what are some ideas that you keep coming back to, either in conversation or in describing maybe your business philosophy? What are some of your isms? What are some of the things you keep going back to?
Well, I think it's always different, right? Because the ism, I'm assuming you mean by that, would be like an advice, like kind of like my templated responses to certain situations.
I think that's fair in the sense that what is maybe advice that I want to say always works, or is like let's just say is generally works. Maybe not always, because we know
Sure.
that it's nothing is one size fits all. But things that are a good starting point for most people.
Yeah. Whether you have a lot of money or not, right? I kind of mentioned it before, the ramen noodle diet.
Yeah.
Purchasing a home is an important transaction, right? And I'd rather you have the money and not need it than need it and not have it.
Right.
And I had a client that closed this year, and when I said that to him, he kind of responded going, that's right. I'd rather be looking at it than for it. So I thought that was a pretty good line. But
That's a good ism.
yeah,
right
that's
there.
a good ism. So, I think that's the one that's applicable across the board. You're buying a home right now. If it's not a necessity, hold off on it, right? Whether you have a lot of money, you still shouldn't be going out and buying a car, right? Or making other transactions without getting me involved. I had a client that was going, hey, my dad's asking me to co-sign for a mattress, right? At Serta or wherever she was,
Right.
And, I said, you can't do it. If you
Right.
do that, you can't, your ratios will be too high to qualify, right? So I think that's the big thing, is by setting that expectation up front. Whether it's somebody who needs to save the additional money, right? Then, that's fine. They have it, right? And I go, listen, if you don't use it, that's great, but we're going to set a goal of saving of this, right? And we're going to put you on that ramen noodle diet. And, and usually it kind of inserts a little comedy to it, a little
Right.
humor. And so it doesn't hit the same way as like me telling them you don't have enough cash, right? So I think that's the one that's probably generally applicable across the board as an ism of mine.
Yeah, it's funny because even mattresses are like pretty much like new cars
Yeah.
nowadays. So
Very true.
yeah,
Yeah.
it could come down to a decision that minor where some. It's good thing that this person got you involved.
Yeah.
Because obviously who doesn't want to help out their father.
Yeah, and it was an issue where, I don't know, something had happened to his, and it's so like my heart broke for him. But I was like, listen, if you want to be able to become a homeowner, you can't do it.
Right.
Yeah.
Right. Yeah. Now, have you, as your time as a loan officer, or in your time as a loan officer, can you think of a light bulb moment where there was something that came to your attention that changed the way that you do business? And maybe it's the fact that you now are very responsive, or something else. But
Yeah. No, great question. So, so I would say my biggest light bulb moment in my business was it was about 2018. I was using a lot of technology and kind of chasing the shiny nickel down the street.
Right.
Right? It was sort of distracting to me because I was focused more on implementing technology. And so I started to, the light bulb moment hit after I was like, I'm not getting 5-star reviews, right? I think we're close to about 600 online 5-star reviews across all of our platforms.
Okay.
Right. Whether it's Google or
This was back then, or is it?
no, this is today.
Now.
This is
Okay,
right
all
now.
Gotcha. Yeah.
Right. But I had always gotten 5-star reviews, and I was like, I'm not getting 5-star reviews. Why is that? And I did a self-evaluation, right?
Right.
And I realized I was using technology to replace me, right? And people want to work with people, right? So in that, I was thinking transactionally, and people typically think transactionally, but they make decisions relationally,
Right.
right? And if you're helping that client relationally rather than transactionally, it's a different level of relationship, and you're gonna get that 5-star review because they're gonna feel it, right?
Right.
And so I realized that at that point I was no better than some of these online lenders, right? Where I'm just a phone number, right? Or a call. So I went away with that, and I doubled down because in my business there's a lot of big teams, right? My competitors have a lot of big teams, and I have people that jump in and help. But I realized I need to be the consistent from start to finish, right? Because people will refer, let's say, a competitive loan officer, at another, mortgage company, and they talk to that person maybe one time, and that's it. They never hear from them again. And I said that, you can't do it. Same thing when I got into the business, and I was like, I was just 9 to 5, right? And people were concerned on the weekends, concerned in the evening, and I wasn't there to help, calm or calm their
Right.
fear or give them an answer, and so similar thing kind of happened. I was like, I need to be the consistent from start to finish. So at that point I started to use technology to leverage me. And so COVID kind of helped with that too, because now I do a Zoom pre-approval consultation with every one of my clients, so I still get face-to-face time. It's more efficient, it's faster. And we educate them on the options right then and there. And then I also do a pre-purchase consultation where we go over numbers and next steps with the clients once they've gone under contract, right? We go back to the drawing board. Does how we issue the pre-approval still make the most sense, right?
Right, because these things typically are going to take a few months.
Yeah.
And especially if it's a buyer, they could be searching forever.
Yeah, well, exactly. And one of my clients, under contract right now was, purchasing a home. Initially, they were going to be putting 20% down. We had the conversation about them putting 10% down, right? And then, that was at the pre-approval consultation. Then once they went under contract, we did the pre-purchase consultation. And the property that they were buying, they go, really needs a new kitchen. Like, it's wicked outdated. It just needs a ton of new stuff, right?
Right.
So the conversation at that point was, what do the numbers look like if we just do 5% down, right? So, that's kind of cool because it shows that our system constantly makes sure that they're getting the best product. Once again, it's about efficiency, for financing that property, right, and effectiveness of the financing strategy. So, I would say as a light bulb moment, that was probably the big thing for me, was utilizing technology to leverage myself, not replace myself.
Okay, yeah, that's a good insight. So the technology is kind of in the background, and you're the human face, and like you said, you make it a point to be the point of contact through the whole process.
Correct.
Yeah, that's great, and obviously, technology is best served as an augmenter, and not a replacer. I would probably say in most scenarios. Certainly, there's places where it's done more, where it's been more effective. But
for instance, let's take an industry like accounting, right, or tax preparation, right. The big online companies haven't replaced the small CPAs and tax preparers, right? Once again, that's because people want to work with people, right? And so, similar thing in my business, right? There's companies trying to, get rid of the position of a mortgage loan officer, right? And I don't know, maybe they will, maybe they won't, but they're going to have to figure out a way to have the relational part of the transaction with the client rather than it just being transactional.
Yeah, and I think, ultimately, we've kind of stayed on this, but I think it's important for somebody to know that there's another human at the end of the line
Yeah.
for whatever it is that they're going through.
Yeah.
Because there's the chance that person will be able to maneuver a solution
Yeah.
for whatever pain or whatever problem they're facing.
Yeah. I mean, I'm certainly no therapist.
Right.
No degree, no professional counseling.
Right.
But a lot of times I feel like one in a transaction.
Sure. Okay, so what's next, and maybe what's the dream? I want to say, I'm going to ask it this way: what's the 60-day plan, and what's the 60-year plan?
Well, okay, so the 60-day plan, like right now we're doing our business planning, right? So we're formulating a kind of our strategy of how to attack the market and pick up market share, because I think that's the biggest piece.
Right.
Once again, I kind of alluded to the fact that mortgage loan officers, because the business is tougher. It's like when the going gets tough, the tough get going. Man, I love the grind. I
Sure.
love the work. Sometimes I complain about it if you ask my wife, but I love it. I love every minute of it. I love doing the work. I still have the same excitement as I did on my first loan, right? And I just love grinding it out and finding solutions to tough loans. Like, one of my favorite things is to like come in and help a client that got a no from somebody else and
Right.
turn it into a yes, just because you know how to solve the puzzle. Like, that's I love that, right? And so I think for me right now, it's how do I take advantage of other people in the mortgage business, my competition, offering like subpar experience, right? And lack of knowledge. And maybe they're tired because we've had a lot of challenges over the last 2 years and a lot of difference, right? We've had it where we had these big teams and we were we were very less hands-on, right? And we could focus more with just the client. Now we're doing more back office stuff, right? Because there's less units to justify having that many bodies. So a lot of loan officers are kind of in a negative mindset where they're like, oh, I have to do income calculations. I have to request paperwork. Like, you just got to love it. So for me, it's how do I take it over the next 60 days? It's how do I take advantage of my competition and grow my market share, right? My units might be less than they were in the 2020, 2021.
Right.
But what does my market share look like, right? And that's growing substantially, and that's what's just super attractive to me right now. So it was the next 60 days and the next 60
years, yeah.
60
what's
years.
What's the dream? Yeah.
Sitting on a porch in a rocking chair. No,
A Fairway can't do that with you though. So what's the?
very true. I think having a legacy, right? I'm not willing. Like, I'll never be the top producer, right? In my lending footprint.
Sure.
Because I'm not willing to sacrifice what you have to sacrifice to do that. My family is a non-negotiable from day one. And so I think, from there, it's looking at a legacy of building what mattered, right?
Okay.
And really a legacy of people you helped, right? I remember one of my most memorable closings or clients was, probably 10 years ago, and it was a woman that walked in to meet with me and the agent, and she had a scowl on her face, didn't smile, and I always try to turn a frown upside down,
yeah.
right? But it was because of her expectation. Her expectation was that she wasn't going to be a homeowner. Nobody in her family had ever owned a home.
Right.
She wouldn't own a home. And I said, you're ready to buy right now. And I literally saw her face change, right? Her whole demeanor changed, right? And that was pretty memorable for me. It was pretty awesome, actually.
I would imagine that's one of those moments where you're like, this it captures a career in a single moment.
Absolutely, yeah. It was, and not only that, but she went out, she found a home. The first home she looked at, she said, I love it, right? I want to make an offer on it. And the agent said, you can't make an offer on the first home you've ever seen. I got to show you one other house. If you still like this home, we'll make an offer on it. She made an offer on it, got it accepted, under contract, and closed. And she's a homeowner today. So that's beautiful. That's pretty special.
Yeah, that's beautiful. Okay, is there anything else that you want to kind of leave the audience with in terms of ideas, philosophies, or encouragements in general?
Yeah, I mean, I think the big thing for me that I'm educating a lot of my clients on, particularly, right? And I think most people, regardless of what industry they're in, most people, the dream is home ownership, right? And that's because it's such an important vehicle to financial future wealth, right? And so that's one of the big things that I try to educate my clients on. Most current homeowners understand that because they've seen their equity position grow.
Right.
I think, once again, I mentioned the average loan to value is like 42% across the U.S. I think that means that the average equity in a home is about $180,000 to $190,000, right, across the country. So they are starting to see that, but they're going, hey, we've seen double over the last 5 years. We've seen double, appreciation rate per year, right, compared to this, historical average, right, which is about 4%, 3.84%, somewhere around there. So it's kind of showing them based on the demographics, right, like how important that vehicle still is going to be for their financial future, right?
Right.
And I think that's a big thing is that most people are like, oh, well, the market has to the real estate market, the values have to come down, right? Now, I can't predict it one way or the other, but what I can use is data to kind of help educate them on that, right? And so, it's no different than a stock investor going, hey, looking at the company's financials, they're cutting costs, they're increasing revenue, like that's a good investment, right? Same thing on the real estate market that I look at, and so I try to educate them on that so that they feel comfortable with making that transaction. On the demographics, right, that we kind of talked about, more people, less inventory. If we've seen rates rise, right, at a really historic pace.
Right.
If rates drop 1%, everybody can pay 10% more for the same monthly payment. So as rates drop, that's just going to push upward value, push values upward. So for me, I think it's educating them on, like, okay, it's not necessarily that you're going to buy and, the market's going to fall out from underneath you. We're not buying Beanie Babies here, right?
Yeah, right.
So I think that's the big thing is that real estate continues to still be one of the best investments that a person can make. 83% of a current retiree's net worth is equity in their home.
Okay, well,
it's pretty staggering.
That's substantial. Okay, well, we've chopped up a lot of numbers here, so this might be one of these episodes that we watch more than once to let it all sink in.
I'm a numbers guy.
No, that's really good, and ultimately, like, ideas are great, but numbers give them kind of put edges to the picture.
Yeah.
So that's critical. Thanks so much for being here, and we'll do cheers to another 60 years for Fairway Mortgage. Okay.
All right, here we go.
All right, everybody. Take care. Thanks for watching. Bye.